All right, we have more changes unfolding in the U.S. economy and the U.S. housing market. Changes that are about to rock the lending business even further, about to go from bad to worse as the Federal Reserve holds an open board meeting today to break down the rollout for the long-awaited Basel III Endgame. That's really the name, by the way, Basel III Endgame. Nothing to do with sports. This is about banks, lending, capital requirements. And we'll explain the implications because there's a ton of them, most notably for real estate as well as for residential mortgages. And we'll also look at, by the way, these brand new numbers just coming out of the US Census Bureau regarding home builders cutting prices. Big movement on new home sale prices, folks. Bad news for the home builders, but good news for home buyers. But before we get started, if you're not already a subscriber of this channel, consider subscribing. It helps the channel out, and I appreciate your support. So the FOMC meeting happened yesterday. All the members met, hashed out their arguments, and like we predicted in the last video, which was obvious, they unanimously agreed. All the members agreed to resume hiking rates, increasing the Fed funds rate now by a quarter point more, which now sits between 5.25% to 5.5%. That's the highest overnight rate that we've seen in 22 years now. But what's clear from Jerome Powell's presser is that it's very likely this is going to be the last unanimous vote. Going forward, we'll begin seeing members break off in both directions, by the way. Here's what JP Morgan has to say about what happened at that meeting and what they believe we'll start to see going forward. Here's what they write. Today, the FOMC unanimously voted to raise the funds rate target range from 5.25% to 5.5%. To be sure, the one clear message that Jerome Powell wished to stress was that policy is data dependent and no decisions have yet been made about the September FOMC or any meeting thereafter. Regarding September, he pointed to the upcoming data releases that come out between now and then as determining the outcome of that meeting. If that wasn't clear enough, they say, Jerome Powell said the following: I would say it is certainly possible that we raise the Fed funds rate again at the September meeting if the data warranted, but would also say it's possible that we would choose to hold steady at that meeting. But we continue. Now, this is JP Morgan speaking, but we continue to think that they hold steady for the next 9 months, which is good. That brings us right around Q2 2024 before the first rate cut and gives the housing market enough time for the 550 basis points of rate hikes to do their damage on real home prices, which has already begun, by the way. We'll look at that in a minute, but first we need to look at this other piece from JP Morgan. If you're not following it, the rule change that's about to go into effect in the banking sector, it's a big deal. Behind the scenes, there's been constant debate about this, about how much stricter to make capital requirements. Basically, how liquid a bank has to be at all times when writing new loans. That's what this is essentially about. And it sounds kind of crazy, right? Like if a bank's writing loans and they should always be liquid enough to do so. Anyways, that will do some real damage to residential real estate, residential mortgages in particular. This goes back to the idea of tighter lending conditions, that the Fed's been tightening things up for the last year, causing banks to write fewer and fewer loans. The bread and butter, by the way, of the banking system. Well, until now, it's only had like a modest impact on the housing market. Instead, the majority of the pain has been rerouted to commercial real estate, corporations, corporate lines of credit, and all the rest, but the housing market's been able to skip by with only modest damage. That's about to change, folks. Take a look at this summary put out yesterday by JP Morgan. They write balance sheets back in focus for the U.S. banks this week, with the Fed holding an open board meeting at 1 p.m. Eastern time on Thursday, today, to detail long-awaited plans for Basel III Endgame. Important to also note, by the way, the majority of the tightening that we've seen banks do so far has come from the small domestically chartered banks. Large banks, though, haven't really been that affected. Well, these new rules are targeted specifically at larger banks. Any bank with greater than $100 billion in assets is what they're actually focusing on. They go on to say residential mortgages. This will likely feed into credit risk, with recent press reports indicating that we may see rule changes around residential mortgage capital requirements for larger banks that may go beyond measures already in place in other geographies. Banks with the largest exposure to resi mortgages include USB with 33% of all loans, CFG Bank with 29%, Wells Fargo with 28%, and RF or Regions Financial with 26%, which is a pretty bad idea, right? When you think about it, banks already don't like the residential mortgage business. Then after this, adding possibly 2% more in capital requirements, which is what they're proposing. That may not sound like a lot, but it is. Banks work on like these tiny margins. All this will do is push more of the lending outside of the regulated banks and into the non-regulated shadow banking sector, to companies like BlackRock and KKR, for instance. Now, they say that the housing market won't feel the full effects of this in the short term, that there's this grace period or a transition period to allow these banks, they say, enough time to build up their capital base. But knowing that these are the new rules, along with the Fed just raising the overnight rate again, by the way, to 5.5%, it's probably enough to do the trick, to really pull back on writing mortgages willy-nilly like they've been doing. Now, speaking about pain, by the way, in the housing market, let's take a look at these new home sale prices, because median sale price for new houses, all right, is falling like a rock in a lot of the country. It's now down 16.4% from peak. That's a lot, folks. You can see the chart here. The blue line is median sale price for new homes, all right? And we sync this data, by the way, into SnapForce. These numbers come from the Census Bureau, just released. Unfortunately, the Census Bureau doesn't release localized numbers the way that the other real estate brokerages do, so we can't view this particular data set by county or city like we usually do on these maps. And by the way, if you want access to this system, I put the link in the description of the video. So take a look at this. Now, keep in mind though, right, there's a difference between this and the chart that we just saw. That chart was of new home sale prices nationally. To see the data by region though, like we're seeing here on this map, they only release it by quarter, whereas the national data set they release by month. So the 16.4% fall that we just looked at, that's nationally using their most up-to-date monthly data set. This map, because we're looking at it by region, West, South, Midwest, and Northeast, we have to use their quarterly numbers. But anyways, it's still useful. So what this shows is peak to current median sale price of new houses. So excluding existing homes sold, all right? Normally home builder type sales, all right? That's what this is. The redder a region is, the more negative median sale price has gone. Green means median sale price has risen. The western region, what do we have? Let's take a look. All right, the West has seen prices fall 3.5% from Q3 of last year. The Midwest down 3% from peak. But the South, look at the South, folks. It's seen a drastic fall. It's now down 15% from peak. All of it happening, by the way, in just the last 6 months, all through the spring selling season, which is the opposite of what normally happens. This will only speed up going forward. A ton of new houses have just recently been completed. Unfortunately, the home builders are like hoarding all of these properties, dribbling them out, trying to milk their current margins for as long as possible. Now, typical new house sold for $437,000 at its peak last year. Today, it's selling for just $371,000, so $66,000 reduction in just the last 9 to 12 months. Still 27% over Q4 2019 and 30% over Q2 2018 price level. So the only holdout here is really the Northeast, all right, which is selling new homes for a hefty premium. Typical Northeastern new house sold for $789,000 in Q2. That's 74% over what the same house sold for, the same new house sold for in Q2 2019 and Q2 2018, and more than 105% over Q2 2015. Now, mostly this is due to record low inventory in much of the region. If we shift over to our inventory map, we can compare this actually, current inventory levels to pre-pandemic levels, June 2023 to June 2019. Clear as a bell, right? The Northeast is starving for supply. Red on this map means a lot less inventory today versus 2019. Blue means more inventory. Now, some of these northern states, folks, like Vermont and New Hampshire, parts of New York even, have 80% fewer active listings right now than they normally do. Absolutely brutal up there. But you may have some relief coming soon, as some home builders have noticed the drought of homes for sale, particularly in these two states, Vermont and New Hampshire. And we know this because along with the new home sale prices, we also have the building permits pulled. Single-family permits, multi-family permits, percentages of housing stock sold versus unsold in each market. So we have it all. And take a look at Vermont and New Hampshire, two of only 3 states in the entire country that have positive year-over-year single-family permits pulled. This won't turn into like the next housing boom town, but they obviously have clearly recognized there's an opportunity to deploy some of their resources there. And if we look at the trailing 3 months, take a look at that. Clearly drawing up plans now for at least some parts of the Northeast. Here's what Goldman Sachs is forecasting over the short to midterm. Here's what they write. Home builder demand robust into summer with permits likely to follow in the coming months. That said, activity has stabilized and we expect a gradual lift off the December 2022 trough over the coming months as builders look to add inventory for later this year and into 2024. We note, though, that many of the larger public builders have increased land spend year over year as they focus on the development of lots and community count growth into next year. And all of this, by the way, the current state of the housing market is like rocket fuel for these home builders, at least until the Fed decides to start cutting rates. And until then, these home builders are in the driver's seat, folks. It's why their stock prices are so high. Their margins are wider today in most cases than like ever before. I think Goldman actually goes over this in this piece. Yeah, up here, they write, looking out, we believe limited existing for sale supply will drive incremental buyers to the new home market, benefiting home builder revenues and margins over the coming quarters. We highlight buy-rated Lennar and KB Homes as among the best positioned in this environment. Now, the big home builders have buy ratings across the board for the most part. That'll change, though, once the Fed finally does pivot. All right, if you enjoyed this video, got something out of it, press the like button. If you didn't, that's all right too. Press the dislike button. Either way, I appreciate you watching.